Friday, December 9. A hastily called space. No emergency here. Although with Thornton around, we got in the habit of doing these spaces when there was an emergency. I just was feeling it. I'm just feeling it. Just a confluence of events. Bullshit market action. Triggered by these idiots on CNBC. We're going to play a tape in a second. Mad as hell. I'm not going to take it anymore. It's enough. Enough. I was at a conference yesterday. StoneX had a conference. That's the firm that the great Vincent Deluard works for. Vincent's a French economist. Wisdom vastly exceeds his tender age. We had him in the space about a month ago, and he gave the case as to why inflation is going to be higher for longer. It was truly a great space. I urge all of you to go back and look on YouTube, Apple, or Spotify. It's about a month old. Listen to that space. Vincent didn't say anything that he hadn't said then. But I was sitting there in the front. It was kind of funny. We'd actually never met before. When we spoke on the phone, we did a space together. So he's up there doing his thing. I'm sitting there in the front row. He had no idea who I was. And then came time for the Q&A. You think I was going to be quiet? So I raised my hand. And I hold up my little lanyard. And he said, "Oh, George, At any rate, he went through, just give a really eloquent case as to why inflation, we'll be lucky to do 4 or 5%, and that's it. The factors that brought us to low inflation, the great moderation. You need to understand that. You need to understand how we got here so you can figure out where we're going to go. Cheap energy, cheap labor, cheap goods. Cheap energy, well, that's done. Okay, energy's come down, but it's still more expensive than it was, a couple of years ago. Cheap goods, well, given what's going on in China now, and the demographics and the deglobalization of supply chains, that's going to be a force for higher, not lower prices in the years to come. And cheap labor. 7 million people have left the labor force. And he went through a great explanation as to how and why. They're not coming back. So for all these people that are huffing and puffing about a pivot and this and that, or a pause, and they contort themselves in every way possible, I just don't get. I just think it's fanciful. And so I sat there in the bond yield breaching, the 10-year breaching 340, listening to Vincent, and I was like, wait a second. Why are yields where they are? You had this counter-trend rally, very, very good one. I did not call it. Be very upfront about that. But you've had the last, few weeks, falling interest rates, falling volatility, and rising equities. And I'm like, no, this is going to stop. It's going to stop right here. So I actually went and shorted some bonds. We had, was a PPI number today. We're getting a CPI one next week. And then Powell telling his usual monthly lies. Into a period of time, it could be a point on the calendar when liquidity starts to dry up. I can't see anyone who's going to make a meaningful stand here wanting to put on more risk. And I could imagine there's some people around who, quote unquote, forgot to sell their ARK or their Tesla or whatever it is, might want to sell a few. Who's going to buy them? There are no buyers out there. You had all the keyboard monkeys, the trend followers, the vol targeting, all these guys piling on. By the way, have you seen, boys and girls, the flow numbers? I know it's too late in Europe, otherwise Shrub would be in here. Outflows. It's kind of interesting that even though the market's had a nice fill-up, ARK is just within a few percent of its lows for the year, as is the Goldman Sachs index of loss-making companies, as is all the stocks Kantrowitz hates. Hey, Kantrowitz, maybe you can stick your head back in here. All the loss-making pieces of garbage that depend on external financing. As Kantrowitz tweeted out, you want to avoid the extremes. You want to avoid the value traps at one end, and the super long duration nonsense at the other. You want to stay in the middle, reasonable companies, at least on a relative basis. And they always say, give people a time or a price, never give them the two together. I'm feeling it. I am feeling it. I was having a conversation with a smart cookie. I don't think he's in the room right now. Hopefully he'll come in here. And he was going through all the reasons why I think the market's going to tank. And I asked him, I said, well, he thinks the market's going to fall 20%. And so I said, all right, if we're in Vegas, what's the over-under? Like, how many months? And first I said, how much market value? He said, 20%. I said, how much will the market fall first half of the year? He said, 20%. I said, all right, let's try and pin this down. How much do you think the market will be down between now? How fast do they go to fall? He said he thinks the market's going to be down 20% before the end of February. Now, look, one can't be so precise. Who knows? Forecasting is a fool's errand. I've certainly proven that. But I just think the setup right now is dastardly. So I want to play. Someone sent me a clip from CNBC today. And I never have anything good to say about CNBC. I don't watch it. My friend Mark Coyotes refers to it as the Cartoon Network, the clown show. And maybe I'm the last guy to have seen this video. I don't know. But even if I was, I'm going to play this anyway because this was just outstanding. Let me just find it here. It was sent to me. It's entitled Flashback. CNBC thinks Sam Bankman-Fried is the second coming of J.P. Morgan. And he writes to me, you must watch this in its entirety. It's only 2 minutes, but you must listen to this. Okay. I fell out of my chair. I think I threw up my mouth a little bit when I heard that thing and at the time when he said, the second coming of Sam Bankman-Fried. But when you listen to this, it's like a catechism. I'm Jewish. Again and again and again. Listen to these idiots. All right, listen to this. Hold on. Let me get this thing cranked up here. It's 2 minutes. I'm going to force you to listen to the whole thing. And I want to see the applause bubbles coming up here as this thing is going on. You can't make this stuff up, as they say. All right, listen to this.
Sam Bankman-Fried is really becoming the industry's lifeline during a crisis lately. I'm endlessly fascinated with Sam Bankman-Fried's role in all of this.
You've been now described as the J.P. Morgan, if you will, of the crypto business.
A lot of people called you the savior of crypto, the patron saint of crypto, the Michael Jordan of crypto, if you will.
The Michael Jordan of crypto.
Sam Bankman-Fried, the J.P. Morgan of Fried, SBF, JPM.
No, LeBron James of crypto.
I think it's cool that the guy has just initials, SBF.
Some on Twitter calling him the hero right now of the industry. There's
Tom Brady ain't the GOAT. He is.
Financial crisis. Or if you go way back, J.P. Morgan in the panic of 1907, bailing out the banks before the Fed was even created.
Sam Bankman-Fried is trying to play the role of J.P. Morgan, the original J.P. Morgan.
One key figure we've talked about has emerged to help stabilize the ecosystem. That is Sam Bankman-Fried.
We talk about him a lot. Yeah. Sam Bankman-Fried. Is he the Jay Gould of our era, or is he the J.P. Morgan of our era? I think it's yet to be determined. Is he Vanderbilt? He could be.
He's the Ivan Kruger.
Possibly. See Carnegie.
The aforementioned
Bernie Madoff.
29-year-old gazillionaire, FTX founder and CEO Sam Bankman-Fried. I love you.
Scam, Bankman, fraud.
It's nothing against you.
The CEO, though, lives a relatively understated life for a bit.
Understated.
Toyota Corolla to FTX's offices in the Bahamas. He lives with 10 roommates and a golden doodle named Gopher. Sometimes sleeps under his desk on a beanbag chair as well.
What about the group sex?
A more sophisticated level of investor than some of the other platforms do. Fair point?
Well, Sam, thanks so much. Such a fascinating conversation. That's Sam Bankman-Fried of FTX.
Sam, don't be a stranger. We love you here on CNBC. Come around, talk to us more often about your thoughts. A lot of other things to talk about.
We love checking in with you too, Sam. Such a good spokesperson for the industry, and we look forward to seeing what you guys are up to in the coming months.
You can't make this stuff up. I don't know where to begin with that. All the clowns on CNBC, from Kramer on down, are they that stupid or gullible? Yes, they are. They're entertainers. Problem is, we don't really have any financial journalists out there anymore. This guy, I trust him as far as I can throw him. Some of us were calling this asshole out 6 and 12 months ago. And everyone's shocked now that this guy's in the way they talk about him. Are you kidding me? And then the CFO, the COO, the woman who looks like she's 12 years old with the glasses. Like, come on. We'll get into this one. Anyway, there's a lot to talk about. I'm spitting glasses, you can tell today. So come on up. Let's get this party started. We got Thornton in the room. We got Joseph Fami in the room. We got Kantrowitz in the room. Raise your hand. Let's get going here. Nicoski, can you talk to us about the charts? In particular, Nicoski, I'm going to trigger you. These energy stocks are acting like garbage. And they broke all. Oh, good. Here you are. They broke all. Okay. So now, in the bad old days or good old days, I'm going to pretend like you're visiting me as a client. Okay. By the way, I want you to send me one of your books because I haven't seen one in a while. So the energy stocks have broken trend. They're absolutely disastrous. So I'm gonna push you up against the wall. I got out of my energy stocks a couple weeks ago. It's like get me out of here, term break. So energy I wouldn't touch. I think bonds are a sell right here. Yields are bottom, bond prices have peaked. And I think, this counter trend rally we've had the last couple of months with steady decline in the VIX. VIX is bottoming, equities rolling over. So I just think we're teed up for, we don't have to invoke forever and all time, but at least an interregnum here of back to our regularly scheduled program for 2022, which is down and to the right. Mr. Nicoski, the floor is yours.
Hey, we became bearish about 2 weeks ago, and I think we made a great call, and I've seen Tommy's call too, so congrats, Tommy. There was a diamond pattern on the S&P that we highlighted. Usually they're pretty powerful, and that one broke to the upside and took us for a nice move up. But, I've been a proponent all along that, it's going to be a bumpy ride, and even on that rally, it was the large caps that were gaining. You look at the, performance of small caps, they underperformed. I've never seen a market make a bottom where the small caps didn't, at least enjoying the ride, if not mark the bottom in most cases. I'm more of the bearish front when it comes to the indices. We've been, a strong proponent. October 12th, we upgraded the industrials. They've had a good run. I guess I'm of the belief, at least on a relative strength basis, energy's pulled back where I'm hoping it gets a bump up. But, the pattern's ugly. I highlighted it on my Twitter feed. Can't go against the grain of the absolute pattern, but relative strength is right, back at the 19 levels pre-COVID. So, I'm watching them closely. I don't want to go out and, bang the table either way on it. They certainly don't have, the wind at their back in terms of the absolute pattern. The market just seems like we get up to that 200-day. You see it on NVIDIA right now. But a number of stocks have rallied to the 200-day and are failing. Amazon still looks like crap. You still haven't taken out the generals decisively. Tesla's breaking down, but, Apple certainly is not, hitting a new low yet. And until that happens, I think we're in the seventh inning stretch. I think the bonds right now are telling us risk off, and the market hasn't gotten that message yet. Despite that, but I think bonds will be more of a tell for a risk off. If the dollar rallies, it's going to be risk off. We made a call that the dollar had peaked, and you had definitely descending highs in it. And right now, I think we could probably get the dollar to pop up if there's more fear in the market. But yeah, it's not a stock market; it's a market of stocks. We've been successful at highlighting, a lot of the consumer discretionary names that have had decisive breaks of their downtrends. The Burlington, Ross Stores, TJ Maxx, American Eagle, Abercrombie and Fitch. So you are seeing at least, the average consumer discretionary stock is doing much better than the XRT. And I think that's a sign of, how we get out of this is we need more individual stocks that don't have the weighting in the index, to start to peek their head out. Again, it doesn't mean that, everything's fine and dandy. I think we're in that seventh inning stretch, and those last two innings decide the game. And I think it's to the downside more than I think it's to the upside.
So Dave, just because you're such a nice, well-adjusted guy, and you're not a mean financial pervert like yours truly, you euphemistically described it as a seventh inning stretch.
Yeah.
What about if we're going to get like a huge hurricane coming and the game's going to be called off because of a giant rainstorm? That's kind of my view.
Yeah, the last two innings, can decisively change, what I'm saying. And, when you look back at the tech bubble, if you would have bought any old economy stock in March of 2000, you made money. You didn't want to buy vacuumcleaners.com that went up, 20-fold because they changed their name. And this, from what, at least my side of the desk, value over growth, people don't understand, it's like, you when you as a fund manager pick, growth or value, small cap or large cap, you may be out of favor for years. All the money in the last, 8 to 10 years have gone into growth. And, that needs to unwind. Money has come out of value during the last 8 to 10 years. And that needs to go back into it to prop it up, just like any normal cycle. The years of QE and zero interest rate policy are over. The only way the Fed can do anything is lower rates again. But, we all know what happens when they lower rates. It sends a signal that, hey, things are a lot worse than what.
So Dave, let's just go to the charts here because you looked them, you and Thornton. We're gonna do Cantro next and then Thornton. So I want to talk specifics right here, right now. I want you to name, when I say name names, I don't mean names of energy stocks, but specifically right here, tactically. I'm not talking about long term. I'm talking about, say, the next, few weeks, months, whatever. What's your take on oil, the dollar, and bonds?
Oil is ugly as heck on the absolute charts. Again, I don't like the absolute chart whatsoever. The best I can say in terms of crude oil is you're back at the relative strength support levels of 19, but that's not the reason to go in. I need to see a reversal of absolute, and the relative strength. So it's bearish. It's definitely bearish. The U.S. dollar, I still believe that is a top. And if the market sells down, we'll get some type of reversal and we'll get one hell of a rally. That will signal the risk off trade. I'm sorry, the third question, George?
Third question was the 10-year bond prices. Yields went, from like 420 to 340. We're up, where are we, 356 today or something like that? What do yields look like to you? What do yields look like to you?
They're way overbought. I mean, I don't think we can continue to climb at the rate we were. So I think we need, kind of a double bottom on the longer term chart. Usually that can come in, 2 to 3 months out. I do think that was the bottom in terms of the safe play. The risk off, trade obviously didn't work and was actually the biggest, loser in the market this year. But I do think that will return. It's just a matter of, you don't wake up one day and say all in or all out. Oh, it's kind of a murky area, and I just think that rally has been way too fast.
Yeah, no, I'm with you on that one. I mean, as I said at the lead-in, listening to Vincent yesterday laid out the case as to why bonds are short or yields should go up. I'm thinking to myself, the only way yields go down from here is if it's for the wrong reasons from here. It's because we're going to have a freaking recession. So I don't know. All right, so hold that, David. That's a brilliant survey by you. Please stay there. I'm sure you're going to have a lot of questions. I want to go to my good friend Michael Kantrowitz and then Tommy Thornton. Kantrow, good to see you. What's up, man? What are you saying for yourself?
Hey, George. How are you? I was listening to Dave and definitely agree with a lot of what he said. When you look at these, we've had 3 big bear market rallies this year. The 2 big ones in the summer and just now. And there's some stark differences between the summer's rally and the last 5-6 weeks or 7 weeks in the market in the rally. And I think you touched on it or David touched on it. The crap is not bouncing. And you go back for every market bottom, which most of those are economic bottoms or housing bottoms. You get a huge move. And while cyclicals have led in this rebound, or had led in the rebound, it was a very strong quality tilt. Companies with strong earnings and good fundamentals have destroyed, and again, ARK is your perfect example versus Microsoft, just a stupid, silly example, or the IGV or whatever. So that is a telltale sign, in my opinion, because markets that are bottoming or strengthening after such a sell-off usually see crap work for a while. Not that we expect that to work for much, for a long time anyway, because this is not the end of the economic downturn or nowhere near it. And there's a lot of funky stuff going on when you look underneath the surface. So one of the things David said I couldn't agree with more is it's a market of stocks, not a stock market. And we look at factors, a lot of factor analysis, a lot of factor work. And, one of the biggest misconceptions this year is that small caps are outperforming. And, there's a difference if you're an asset allocator and you have to buy, either the IWM or the, Qs or the S&P 500. Yes, I'm not talking about small cap indices. Small cap indices have massive sector and cap weighting biases. When you look at small caps versus S&P 500, it's basically energy and financials, industrials versus tech. So yeah, those other sectors have done great relative to tech, and that's the only reason the small cap index is working. When you look underneath the surface at the market of stocks, larger companies within every index, within every sector, are crushing smaller companies. It's not even close, which is consistent with a down tape, with a higher credit spreads, a lot of volatility, everything we've seen this year. This is not a risk-on environment. And so I thought, that's pretty interesting. And again, if you look at like the crap of the crap, small cap value companies with no earnings, that stuff should be up 30-40% if the market is bottomed. And I know it's relative performance, and most stocks' absolute performance are at new lows. So it's just, the flavor of the leadership in the market makes a lot of sense to me, because earnings today, the global macro backdrop today, at least from an economic activity perspective, putting inflation aside, is clearly worse than it was 6 months ago when we had the last big rally, or 4 or 5 months ago. And so the further we go on into this downturn, we're going to have plenty more bear market rallies. The Fed will be done at some point. The Fed will cut at some point. Who knows what else will cause it, but the leadership in these rallies are going to be more and more narrow and higher quality, and probably shorter in duration. Doesn't mean they can't be explosive, especially initially, but I think that just continues to support the idea that earnings are starting to matter a lot more than inflation. And if inflation doesn't come down, to your point, George, then we're really screwed. So that's kind of
yeah. And I have this nagging fear that we're going to get both, Cantrell.
And then in the next 4 months, the economy's not weak enough to get inflation massively down. I mean, today we got PPI that was hot. Monday, which probably nobody saw, the ISM Services Prices Paid Index at 70. It's been at 70 for 5 months. And so a third of the inflation problem is going away within manufacturing. That there's clear signs of that. We got supplier deliveries in manufacturing are below 50. ISM manufacturing prices paid are at 43. Inventories are coming down to 50. So there's signs across the board that goods deflation is here, but call that 30% of our economy. And ultimately it all comes back to employment, and that's where inflation is still red hot.
Yeah, and apropos of that, I can't remember where I read it. For all I know, it could have been something from Nancy. By the way, Cantrell, can you get Nancy to come into one of these spaces? I really, I'd love to have her. There'd be a lot of, you can bring a tag team, the whole thing. You bring in Nancy and Pearlie and whoever. This would be a lot of fun. I think it'd be a hoot. But anyway, I don't know if it was something Nancy wrote or I saw it somewhere else. People were pointing out the wage gains still accelerating and the gap between the quitters and the stayers. And so, again, going back to Vincent yesterday, we're nowhere close to this labor market beginning to soften to the degree necessary. So I just put it this way: we may get the slowdown. We're getting prices paid coming off, whatever. But labor, and Kendra, speak to this. For the typical company, Kendra, you know this probably off the top of your head, but on average, labor isn't labor like forget about extractive industries, but for most companies, isn't labor like a very material part? Was it like 14% of the income statement? I can't remember. How much are wages?
Of expenses?
Yeah,
within the services industry, it's like 60 to 65%.
Right. I was thinking overall, though. So wages are a huge deal, though. So stay with services just for a second. Right now, it's true that companies are still gouging and jacking prices, but if you're consumer facing and you start to have price resistance, like you see with some of the retailers, but your costs are still going to the moon at the time of your inventories, I'm sure Lululemon inventories up 85%.
Yep.
Come on. So Cantor, seriously, we get the slowdown, but it's kind of like Goldilocks. Well, it's not Goldilocks for earnings, but it's not so cold. It's not so hot. It slows, but not enough. As I think you've said before, many have said, bad news. We're in a place there where bad news is good news. You don't want good news. Good news is bad news. So let's say we slow a little bit, but not really all that much. And you want to know something? We have Michael Hallen here. I don't know if you heard the space, and I'm not sure I agree with the investment conclusions. But one thing which is unassailable, he rightly pointed out that at the margin, the economic news has been coming in better than expected, not just in the U.S., but in Europe of all places. And that's largely a function, I think, what's been happening in energy prices. So let's say, as someone had written the other day, this is going to be the most widely. All right, so let me play this one back on you, Cantor, okay? If we get this recession, and I thought we'd have a recession already 6 months ago, but let's say we don't get it. People point out this is going to be like the most widely anticipated recession like ever, all right? Let's say we don't get a recession. Let's say we get like a slowdown, but that's about it. What is that? How does that speak to you in terms of profit margins and valuations?
Well, if you don't get a recession, you're not going to get costs down. You're not going to get rates down. The Fed's not going to cut just because CPI falls unless it's really low. And if you're not going to get a recession, you're not going to get CPI really low. So it gives us this kind of L shape or really wide U-shape recovery. Think about ironically, the harder we fall, the harder we'll bounce. So, the soft landing idea, I think, is a disaster. If I don't buy it. I don't think we're going to have a soft landing, and I think we're going to have a lot of unemployed people. And forget about. I don't care about GDP. I care about employment, earnings, and credit risk, and they're all going to get worse. And I think everyone's debating the same exact thing. Literally every client I talk to says two things. Everyone's bearish, so that's got to be bullish. Literally everyone says that. So it becomes really circular because if everyone's bullish because everyone's bearish, well, what the hell does that mean? I don't know. It gives me a headache. But what I do know is the fundamentals are going to get worse. Everyone agrees with that because it's obvious. Any macro forward indicator you look at is pointing straight down for the next 9-12 months. So, yeah, everyone should be bearish because we have the backdrop. You couldn't create a more bearish outlook. Everyone's getting excited when the market goes up because bond yields and inflation soften up. That's what should be happening here.
But Kantrowitz, I wanted you to drill down further on one point you made, which is if we don't get the big down, if we get this soft landing, and I'm not sure I believe in the soft landing either, but let's just suppose that we do, the implications for the lack of monetary and fiscal stimulus will come out the backside of that. It's just horrendous. We'll be in this sort of holding pattern twilight zone. That's just a god-awful environment for stocks, is it not?
Yeah, and again, it's the whole soft landing idea. Every landing in the U.S. economy and every bottom of every bear market corresponds with a bottom in housing. And I've said this ad nauseum, but it's true and it makes sense. And that's the most important thing is that it makes sense. It's not just correlation, but it's causation. And so if rates don't come down much, to the extent housing gets better, which is ultimately, if housing doesn't get better, nothing gets better. It just gives us this limp, weak economy that'll ultimately have a recession. It'll just take longer. And I think that's going to be the interesting thing next year is I think in general we still had 7% nominal GDP in Q3. As bearish as I am, again, it's a process. It's a spectrum. I don't think the market's going to fall 30% in the first quarter of next year because we're in between maybe the end of a bond bear market, even if rates go up a little bit. Listen, again, if they go to new highs, then we're really screwed. But given the softness in the economy and a lot more of that to come. I don't think we're going to see new highs in rates, at least the first half of the year. And that'll keep people bullish. And at the same time, we have really high nominal GDP. And so we're not going to fall off the cliff on the economic front quite yet. Again, it's a process, and it's all happening. I think patience is going to be paramount. But positioning, going back to what David was saying and what I was saying about this rally, positioning in the last 3 months has become decidedly, very clearly, even in a rally, very tilted towards more quality names with better fundamentals. And that is only going to intensify.
Kantro, one sector, I note the god-awful performance of financials lately. And you can't really have a healthy market if financials aren't performing. And so what's your take on when financials or how badly they're performing, and what does that portend in your view?
Well, I think the fundamental story behind financials is behind us. Everyone was excited because rates were going to go up. Loan growth is strong, but that's the caboose of the bullish story there. And any forward-looking indicator of loan growth is pointing straight down, like lending standards or the LEI index that leads loan growth by about a year. So this is as good as fundamentals are going to look. And we've just seen forward earnings for financials kind of flatten out. They really haven't gone down much because, again, the reality is people look at lagging data. I pull up reports on financial stocks all the time, and these analysts talk about how great loan growth is and how it's going to get better. I don't know what they're looking at, but that's like saying how great employment is right now. Like, of course it's great. We just had the biggest economic boom in 2021 in history. So I don't like financials here. Their NIMs have peaked. Rates are going down or starting to go down. Growth is going to considerably get weaker. And as we start to see some credit risk, which I think is going to be the story of the second, third, fourth quarter next year in a big way, financials is the last place you want to be. And again, it's all about probabilities and where do I want to put my money to be long short with have better odds of success making money. It's not about, are we going to be repeating 2008, or are we going to a hard landing? I think it's just that, are things going to get better next month? And we ask ourselves the same question every month. It's just going to be no, until we bottom.
Kantro, last question, and I'd love you to stay in the room, but I know you have you report to your daughters, and you got a lot of other things you got to do. You got a life outside Twitter. Could you just speak to your updated views on your earnings estimates? You were in the vanguard of speaking about the earnings debacle that we're going to have in 2023. Others have now followed you. I see Deutsche Bank cut their numbers, Mike Wilson cut his numbers, et cetera, et cetera, et cetera. But what is your best guesstimate for 2023 S&P earnings, and how has that changed at the margin in recent weeks?
So I work with, Nancy, an economist who is an economist at ISI Group for 40 years practically. She's got a pretty low number at 180 for next year, which is probably one of the lower numbers I've heard besides your buddy, I'm sorry, I forgot his name. I haven't been on a Twitter space in a long time. The guy was saying like 120 or 110.
Yeah, Michael Belkin. Yep, go on.
Belkin, yeah. So Nancy's got 180. I'm not even going to pretend that to try to forecast the earnings number in a recession, because I think it's kind of a silly exercise. Because A, I'm not going to be right. B, if I'm right, I'm lucky. And C, it's not even going to matter. So earnings are
Kantro, I mistakenly muted you. Could you start speaking again? Please unmute yourself, Kantro.
Okay, where did I cut off?
No, I lost you 5 seconds ago. Just pick up where you were 5 seconds ago. My bad. Sorry about that.
So estimates, I was saying that I'm not even going to pretend to try and tell you where the earnings is going to be next year if we get a recession, because things break. You get things that you can't model happen. So it's going to be bad. I don't know if it's 180, 190, even 200. But again, what matters more is that how long are those earnings estimates, where are they now, and how long are they going to fall? And the work we look at, it says it's another 12 to 14 months of declining estimates. And if we get a recession, that's where, things really fall apart quickly. So when we asked me this same question probably about 9 months ago, So the way we think about earnings is saying, where's consensus and where's it going? So 6 months ago, consensus for 2023, forward-looking, was at 251. Started the year at 245, got as high as 251 in June, and it's ended the year is today at 231. Our estimate since May is 230. So great, we nailed it. Again, that doesn't really matter that much. It's helpful, and it helps you think about where you want to be positioning, but at the end of the day, it doesn't really make a difference because it's not the realized number, but that's what's kind of priced in. So the question is, where's that number going to go as we get into 23? And then the number for 2024, which is going to be increasingly relevant as 2023 progresses, is 254 right now. It's out to la-la land. No slowdown, no recession priced in at all there. And so I think that's going to come down 15%. Again, this is forward numbers. So again, I'm not trying to say what the earnings are going to be. I care about where consensus is, where it's going to end up, when, and how far it's going to fall. So when we model that out, it's about 15%. And then you got to think, okay, well, we get some bad things that happen and the forward numbers come down 15% because analysts never really price in a recession in their estimates. Never happened, never will. So the question is, how low is the PE going to go? And when will that bottom? And that gets back to how high and how long will credit spreads rise? So, it's not a simple thing to answer and the way we think about it, but the answer is a lot lower. I mean, that's all you need to know. And when
Mike, I was going to push you on that because, like, whether we put in, 180, 190, 200, whatever for 2023, with the market at 3,900, I mean, you can't get from here to there. It's lower. Whether it's 3,500, 3,000, it's lower. Like, I mean, This makes no sense, the market valuation now, does it?
And, well, I mean, the valuation is where it is based on, credit spreads have come in a little bit because, again, the whole market is so myopic. Market does not look forward. Investors do not look forward beyond the data they have today, and that every day new data come in, and that changes their forward-looking view. So everyone's really reactive, right? There's no way you can say any kind of recession's priced into equities or credit. And so, do I want to short everything right now and expect a 20%, all of a sudden people are going to price in that recession or that slowdown, the full extent of it? No, it's going to happen. It's going to play out as it happens. So for all that, again, we'll see what happens in a year from now, but let's remember this conversation because you've said it a million times. Everyone has said it a million times. This is the most telegraphed recession in history. Everyone's bearish, so it can't happen, and the market can't go down because of that. My bet is that something bad, the market's going to not perform well next year. We're going to have something that looks like a recession, whether GDP is negative or not, right? Because we have high nominal GDP. Claims are going to go up. Credit spreads are going to widen. Stocks could fall 10, 20, 30%. And we'll once again kind of call bullshit on this whole idea that everything's so forward-looking, and just because people are bearish, and I think they should be, that really means anything beyond, the short term in terms of positioning in the market.
Michael, I'm just going to remind everyone, invoke Walter Deemer's great line, and I quote, "It ain't when everyone turns bearish that's important. It's when they finish selling." And the public hasn't even begun to sell, so amen. Kantrowitz, if you can hang around, that's wonderful. Really, really great to hear from you. Please, anytime, you're always welcome. Let's go over now to Tom Thornton. Tommy, you there? The floor is yours, Tommy.
Hey, George. How are you? Wow, it's hard to follow up on Michael and David's comments. I'm in L.A., and where I'm staying, somebody has a blower outside, which is so typical of L.A. But anyway, I wasn't really around the market that much today because I was flying, but I've been really focused on watching some of the ranges on the overall market, and 3,900 was essentially the gap up level after the last CPI. And I think that if the CPI, that gap up level breaks, I think there's a 3 to 5% air pocket lower that could happen. And I've been positioned for that. It's tested it a couple times and hasn't broken, and it sort of failed. It looks like late in the day again, but we're still hovering above those levels. on the triple Qs, we broke a little below that those levels, I think, yesterday, and I'm just I still I'm in the bearish camp. I will occasionally masquerade as a bull and find some opportunities on the long side, and I did do that, and then I basically got out of them, and I will say I got the highest net short exposure this last week I've had all year. And
Stop.
What? Well, I'm just telling you.
No. I will break in. I just want people to understand that. As opposed to yours truly saying he's bearish, there's no information content in that. Thomas Thornton is a very normal, well-adjusted human being. He's got the biggest net short exposure of the year on right now. Ladies and gentlemen, please pay attention. There's serious information content in it. Sorry.
But I wrote this also yesterday on my note. I said, if I've had a freaking knockout year, and so I've got a lot of gains that I can give back a lot if something miraculous happened and I'm caught short. But the point is, do not follow my direction if you're not up or you're trying to make up for a bad year, because I've got cushion, and that's why I'm doing.
Okay. So Tommy,
so that's I'm putting a disclaimer.
I'm gonna make it difficult for you. Okay.
Oh God.
So let's say it'd be like if you and I are talking to Congressman. Let's say you go to visit a new client. You got a new client for the first time, all right? He doesn't think you're a genius because you're up 43% or wherever you're up this year. He doesn't think of an idiot because the last bad call you made, whatever. He doesn't know who you are, right? And you're trying to impress him. Clean sheet of paper. Mm-hmm. What would you tell him to do right now? Go tread cautiously, little long, little short, spread trades. Like, you get no credit for what you did. And as my former boss, Peter Lynch, always say, the thing about this business, the shot clock always gets reset to 0 on January 1st. Well, it's December 9th. So for a new client who doesn't have a cushion, you're trying to impress, you don't want to put the car in the ditch on the first call, what would you be telling that client to do?
Well, it's actually timely because I'm actually going to be January 1st running some money for a few friends and just outside capital, and it's not going to be public money or anything like that. But the bottom line is I'm just going to scale into positions as I see fit, and it's not something you just can. I want to basically hit some singles in January and start small and build up a lead, and that would give me a lot of confidence. So if I'm short 5% Tesla, I'll short 1% Tesla and add to it if it lifted, or I would just scale into positions. And as I get new ideas, I would just put those positions on as I see fit, and my weightings will be off a little bit, but I still think that that's appropriate. So scaling in. So anytime you start a new portfolio, George, as you know, it's important to scale yourself in. Don't go out of the gate gunning, because you just want to hit singles. It's like a baseball game. You want to get singles in the first few innings, build a lead, and then you can start maneuvering a little bit more aggressively. And that's essentially the view I have as far as putting any money to work right now. And
all right, so now I'm going to put you through the Nicoski meat grinder. I'm going to ask you the same questions I asked him, because these are all key determinants for direction risk assets in the short run. What is your view on oil, on bonds, and on the dollar?
Well, oil failed twice to break out. I think the WTI was like 90 or in the high 80s, and it failed. And you had two DeMarc sell setup 9s, and those broke. And now you have a downside DeMarc sequential countdown on the downside, which is basically extending the trend lower. And it doesn't necessarily have to go that much lower. It can go more sideways to down a little, but I think crude could go lower. Also, crude's energy stocks. I had several DeMarc exhaustion countdown 13s recently, right before they started to fall. And I really didn't believe it. And I had a client say, well, why didn't you short them? And I said, because I like the sector. and I want to be a buyer of the sector in the new year, and I just didn't want to get cute. And so that was that. But that's my energy call. I actually, sorry, I like natural gas here. So I'm long a natural gas stock. And I think natural gas is putting in a bottom right now. So I like natural gas over crude because there's a DeMarc buy countdown 13 down here. And let's see what else. Dollar, that actually peaked pretty uniformly with a couple different DeMarc sell countdown 13s. You have a countdown 13 in progress on the downside. So I wouldn't be shocked, and I'm not necessarily pushing this as a trade, but I wouldn't be shocked to see the dollar move a little lower. As you can tell, George, my voice has been horrendous. As you know, I've had a cold.
All right, so we will mercifully.
What's the last one?
The last one is bond prices, interest rates, 10-year.
Yeah, as Michael said, they're doing what they should be doing if we're going to move towards a recession. So I think you could see rates go a little bit lower, and that had confirmation from daily and weekly time periods. So I think that, I'll say it, and I'm happy to change my mind. We might have seen the peak in this cycle for rates and the yields, and if that is the case, I don't necessarily think we're going to 2% on the 10-year, but I think we could see 3%. And maybe this last week was a bit of risk off type of positioning that we normally used to see when equity started getting wobbly. People would rotate into bonds, and that was sort of a thought I had looking at some data.
Tommy, with that last thing, without getting into names, I don't want to get too many picks, but when you look at the shorts you're putting in your sheets, and I get your. By the way, I urge everyone to reach out to Tommy and trial his service. It's a tremendous product, and it's an extraordinary value. But when you look on your sheets, the types of things that you're short versus longs, you got a lot more shorts than longs right now. You very ably managed to rent your longs, and that worked out really well. But when you look at your shorts, either by sector or factor or style, are there any general comments you make about the things that you've got on the short side?
Well, they basically, I try to not focus and overweight one sector over another. I don't like to get more than 20% in one sector. That just is too crowded for me. I rarely build positions over 5%. That's also another important thing for me. But I would say, look, I've got a steel name. I just added a Chinese name that I can't pronounce the name. I don't even know what they do, and I feel like that Mark guy. But all seriousness, I didn't even care, and I was just laughing. I'm like, I can't pronounce the name. It's an ADR. But anyway,
okay. All right. So I'm gonna.
But wait. I'll say it's important. I have some consumer names that I'm short. I was short Lulu. That was nice today. I'm actually very focused on financials, and I'm short XLF, and I'm short the largest weight, which is Berkshire. I'm short JP Morgan, MetLife. Yeah.
What about some of the industrials and the transports? Because those things are starting to look pretty wobbly. Not yet.
No, I'm short. I'm short Boeing. I'm short. I was short XLI, and I bounced out of that just because, not necessarily because something changed. It's just I was going on vacation this weekend, and I'm going into the end of the year. I'm completely wiped out and exhausted from this market, which has taken a toll on all of us, as I think everyone would agree. And I just wanted to have some less exposure and sleep a little and try and rest myself.
You're entitled.
But I'm also short some garbagey stuff. I think Coinbase, I've been short that for a while. Or Tesla.
The electric car company that shall not be named. That looks like crap, doesn't it?
Well, it's Jim Chanos had he's always great. He did a Spaces the other day, and he always said to me, he goes, we got to keep Elon in the driver's seat, as CEO. But it's even better when he's like now totally focused on on Twitter, and and this is a time where I think Tesla needs massive amounts of attention if demand is starting to wane. Right. And so this is, I mean, it does look terrible. I think it could be, if the dam breaks, this thing could go lower. And again, I think we're watching like the 3,900 level on the S&P. If this starts to break, I think it's going to be 3,500. We could go lower if Michael's earning estimates and Nancy's earning numbers are correct. We're going to definitely see below 3,500. So I'm
sorry. Go ahead.
So that's what I'm watching. But the point is with Tesla, or the name that we won't name, electric car company. And oh, by the way, Gordon Johnson, that one, you get him going.
Yeah, Tommy. Woo! The reason I interrupt you, almost I want to get Gordon back up here. We had Gordon a couple of weeks ago, but I need my weekly injection of Tesla bear porn. So hopefully we get Gordon back up.
Well, listen, and again, for those that are looking to establish a Tesla short, keep your size very moderate. If it works, it's going to work great. But this is the craziest stock ever, and it could squeeze in your face. One other thing. Our good friend Jeff Garbaz and I from Erlanger Research, we've talked. One thing that's really notable, and short interest just came out this afternoon. I'm going to probably have to go through it, and hopefully I'll get Jeff on board with looking at it. Shorts have been covering all the way up on this last rally for the last 6 weeks. And I think that's really, really important. And that's why I've been really set up net short, because I was thinking if there are no shorts in this market, this thing could drop out. And Lululemon, one of the main reasons why I was shorted was that short interest and it has dropped precipitously on this move higher. When there's no shorts, any sort of moderate bad news could get amplified because the natural buyer, the short, isn't there to support this thing on the downside. So that's why you could see some outsized moves. I think also you could see it on some, I don't necessarily short, the typical shorts that that people are looking for, zeros. I was short Carvana way up there. Yeah, I covered it too early, but now it gets really difficult to short because you have these really pronounced moves. I short things that have gone up, have exhaustion signals that exhaust the buyers, and then the shorts are absent, and the bottom can fall out. And I'm not looking for zero on all of them, or really any of them, but just a moderate return. That's it. Okay, my voice is gone.
Tommy, enjoy California.
All right, my man.
I'll talk to you next week. Thanks so much for that. You're always welcome to stay around. People love hearing from you. All right, we're going to go to Storm, and then after Storm, we're doing crypto. Storm, good to see you. Please unmute yourself, Storm. What's up?
Yeah, hey, thank you so much. I've been bouncing around in a lot of rooms, and the consensus is, everybody's kind of, complacent. And I've been listening to a lot of spaces, and one that kind of got me thinking was kind of unorthodox. Grant Cardone's had a space last few nights, and he talked about the CRE market, or the commercial real estate. And he was talking about his own personal portfolio and how they did a tremendous amount of volume in 2021. However, in 2022, they only structured a handful of deals. And from a lot of the different shadow banks, which I've heard that term thrown out there a few times, it kind of, piqued my interest. Blackstone and some other names, and, read through some articles. I thought that was fascinating. And I think, if you look at the technicals, David hosted a great space just going through technicals, throwing tickers out there. We're still on a downtrend. So, I mean, all the haters out there can say what they want to say, but at the end of the day, when you zoom out of the dailies, the weeklies, and the monthlies, there's no catalyst to drive this to the upside. So, I mean, you look at all the major indexes, you go through all the commodities, And the chart patterns look very similar setups back to 2020. Peak dollar, and then we sell off into, various asset classes. So great space, George. Just glad to be a part of it, and keep growing numbers as to the audience, because this is the financial literacy that America needs and deserves. Because until they're able to rebalance their portfolios, take a breather like Tommy was talking about, what do you think everybody else on Wall Street's doing? You think that they're going to actively trade up until the end of the year? No, they're on vacation. They're on a hiatus. And then we're going to go into the new year, and there has to be some type of rebalancing. I don't know. That's just my
All
two
right.
cents.
Yeah, no, Storm, great comments. Really appreciate it. By the way, I want to thank everyone in this room. I'm just going to take a break right here. We've been an hour into this. I call this space on 12 minutes notice. We have over 500 people in this space. And look who's in this space. Some of the best minds on Wall Street. Dave Nicoski, Tom Thornton, Kantrowitz, Gordon, Ken Roberts, Gnostic, David, Neely. I mean, there's too many to name here. It's just amazing the community that we have. The fact that 500 people would get together on 12 minutes notice. We're just trying to help each other, and the strength in numbers. I do want to just take a second time out. Probably, I'm not going to say you're sick of hearing me this. I only mentioned it once in the space the other day. Year end is approaching. We raised $220,000 earlier in the year for World Central Kitchen. I'm starting to play that tune again. And if you've found value from these spaces, and we passed the hat, so to speak, with Michael Howell the other day. But I mean, just think about Dave Nicoski, Tom Thornton, Michael Kantrowitz, etc., giving you all their wisdom for no personal gain. I mean, it's priceless. It costs you tens of thousands of dollars to take research from these fellows. So I would ask everyone, I would implore you to please give generously to World Central Kitchen, pay forward. These rooms are free. I want to keep it that way. But I think in good conscience, if you got, it would cost you a fortune to get the kind of advice you're getting here, please consider giving to World Central Kitchen. I will retweet the link to the charity. This is a high-class problem we have in this room here, people trying to preserve or increase their net worth. There are a lot of people out there who are far worse off than we are. So please give generously to World Central Kitchen. Okay, with that, we're going to go now to crypto. And then after crypto, we're going to have Darshan. Crypto, please unmute yourself.
Hey, what's going on, guys? Thanks for having me up. Just to touch on your point there. That's kind of why I jump into these spaces, and I'm just trying to be a sponge and absorb as much info as possible. So I'll definitely check out what you just mentioned, that link, once you retweet it, and look to contribute in that way, because the value that I've gained from a lot of the heads in this space, there's no price tag on that. Space has been just crazy. It's been an awesome resource of this year, especially in the times that we're in, with so much to learn and so much to look out for. But I just want to shout out to Cantro and Thomas there. Hope your voice does well and you have safe travels. But I wanted to kind of look, I guess, into a few things, and I just had two questions that I kind of wanted to run by or maybe get some insight on. I don't know if that's the right place to do so. If not, oh well. But
crypto, you have to worry. If the question's out of line, don't worry. I won't allow it. So go ahead.
No, so awesome. I appreciate that. So I heard Cantro, and I've been following it since he first posted earlier in Q1, Q2 his that hope standard or that metric, and I was curious to see, I guess, what his thoughts would be as to, are we kind of in the third or fourth inning of that, or are we like early stages? Because I'm by no means an expert, and I've more so on the crypto side of things, and just really trying to learn the non-scammy markets at the moment, but just trying to see how bond markets are starting to operate as we do start to see these declines in growth, and as we start to see demand fall off.
Yeah, crypto, you're in luck. You triggered Cantro. He's back. Cantro, over to you.
Oh, sweet. But yeah, so I was curious to see because I heard Cantro there. I got in a little late, so hopefully I didn't, repeat something that was already mentioned. And I'll go back and listen to this recording. But yeah, I know that the markets aren't seeming to price in what seems to be some kind of a recession that is going to have a lot of earnings pullbacks and repricing. When you have McDonald's, that has a PE that's kind of like a tech company at this point, and it's McDonald's. So I'm just trying to. Oh, go ahead. My bad.
Crypto, it's a great question. Cantro is here to answer your question. Cantro, over to you. Where are we in the hope cycle, Cantro? Please unmute yourself. Cantro, can you hear us? Please unmute yourself. Maybe he's stuck in the matrix, Crypto. When he'll come back and be sure to answer your question. Why don't you just wait? He'll come back eventually.
Yeah, no worries. I've had some issues with spaces myself when it comes to that.
It's acting really weird. So in the meantime, let's go on.
Hello? I think I just lost my connection. Can you guys hear me?
Yeah, we got
there.
You.
He is. Yep.
Cantro, where are we in the hope cycle?
I'll try to be quick. The hope framework, housing orders, profits, employment. It's just the oversimplified way of how the U.S. economy works in every downturn and every upturn. The sequence is always the same. The timing and the magnitude of all those components and everything underneath there is, that's where the variables lie. So I'll start real quick at the housing data, and specifically it's MBA purchase index, housing starts, building permits, and the NAHB index. We've only seen the collapse in the real leading part of that story. So the NHB has collapsed to 33, biggest annual decline in history of the data back to 85. The MBA, not NBA, but M like Mike Bravo Alpha, is a weekly data point you get on Wednesday. So everyone should follow that. It's the most timely data on housing demand. And after mortgage rates peaked and came in a little bit, we saw that have a little uptick. And then this week it fell again, despite, I think, mortgage rates coming down even a little more. So the backdrop for housing just remains horrendous and will be really bad when we start to see unemployment go up. That's the real trigger that really makes things bad for anything. So the housing data keeps getting worse. Mortgage rates are not going to save the housing sector if we go into recession, and they'd have to come down a ton to save the housing sector without a recession. So that's still looking bad, and I expect that to continue getting worse and start to show up in new home sales and new housing starts, which is starting to show up, but that data has a lot more room to fall. PMIs, the ISM index, the manufacturing index came in at 47 this past month. 70% of global manufacturing PMIs are now below 50, highest since the pandemic, and before that, since 2008. And everything points that's going to keep going. That number is going to keep going up. So everything suggests PMIs keep going down, and PMIs are profits. That is the macro lens into profit expectations. So the lower PMIs go, the faster expectations decline. And so we're at 47 now, which is kind of middle of the road. We have high nominal GDP. So maybe that 47 to equate it to the last 20 years is probably a little higher because nominal GDP flows into nominal revenues. Profit expectations, we kind of talked about that earlier, but that's now down to 230 for next year. And probably that's going to see another 15% decline in the year to come. And then unemployment, we're seeing, employment soften. Claims are starting to pick up. And that means that people are getting laid off and they can't get a job. So that's one thing to look at. Claims are still pretty healthy and low, but it's not about, everyone wants to debate, well, look, everyone's still employed, things are good. And that's because people are employed. As that changes, everything changes. And every forward indicator of employment just points to a lot more weakness. And the big weakness probably starts in Q2 of next year. So that to me is where it really gets ugly for earnings and financial markets.
Thanks, Cantro. It's terrific, very concise and to the point. hang around, maybe get some more questions. Okay, let's go now to Darshan. Darshan, please unmute yourself.
Hey, how you guys doing? Again, thank you, Tommy, for the wonderful talk. I think, he always has great insight. My question is regarding financials, financial institutions. I wasn't sure if Tommy said he was short financials or he bought the ETF. But the question is, as we see the rates going higher, these banks are going to be able to earn more money on the interest they get from the deposits. So, Bank of America has like $1.9 trillion in deposits. And now their spreads are going to be much wider, and their net interest margins are going to be wider. So we should see, in my opinion, the financial and banking sector really kick off sometime later next year. And, they should start making a lot of money off the deposits that they have when the loan cycles start again. But at the same time, we're going to see a lot more, defaults, and we'll see some slowdowns. So where do we see the banking sector next year? I think I'm very confident in the financial sector. I think, most of the banks will come out winners in this, where it's not like 2007, 2008, where, we had a lot of exposure to subprime mortgages. So, a lot of these banks have excellent balance sheets, plenty of money in their loan loss provisions. So if anyone has any further information on where we see the banking sector or where we see the banks, how are they performing, let's say late 2023, because, in the first couple of months or the first half of 2023, I think the market's going to be pretty turbulent, but I think there's a lot of money to be made.
I got it. Yeah, so Darshan, we got it. So
I'll just jump in real quick. I think in general, you want to go down towards, if you like banks, down towards the regional banks, the smaller banks, the ones that are not exposed to capital markets, banking activity, M&A, stuff like that, advisory, because we've seen a complete shutdown in that activity this year. I think the firm I work for is down like 80% on banking, and that's pretty much the average across the street. And if the economy is going to get worse next year, I don't really see much hope for any kind of big improvement. So we would be kind of avoiding larger cap banks that are far more cyclical. You got to be careful in the small banks, making sure they're not doing anything funky. But that would be my recommendation. But as a sector, I think a lot of what you said has been kind of priced in as people expected rates to go higher, and the lagged effect of that is better loan growth. But at the same time, look at lending standards, which have tightened considerably, especially for business loans, and probably will tighten further. So even though those rates may be higher, the spread may be higher, though I think that spread's probably close to peaking. They're not lending as much they're not going to lend as much going forward, and especially to weaker borrowers where they can really have a fat profit margin. So banks, that's why banks typically do a little better earlier in the cycle. But we're definitely far away from that point today. But I agree with you coming out of this, yeah. And I also agree with you that this is not 08.
Thank you.
But it's 2023, and that can be different.
Thanks, Kantrowitz. That's spot on. Wow, this room is really getting moving now. So we got Michael Kramer and we got Neely. All right, so Kramer, Michael Kramer, why don't you unmute yourself and give us, you've been very spot on with your market call. I know we had a little diversion for a few days there last week, but we're now back to our regularly scheduled programming. So what are you thinking of the market? And then, Michael, after you, we're going to go to Neely. So, Michael, the floor is yours.
So, to be completely honest, this next week is like the most nerve-wracking week of the year, I think, because in a lot of ways it can make or break, a year for someone. When you think about the data you're going to have next week with CPI, Fed, ECB, I mean, geez, you could have an S&P at 4,200 or a 3,400 because I feel like that's the type of momentum right now is behind it. And, if you have a handle on CPI and you have a handle on the Fed, I think that's largely going to determine, where we kind of go with setting up into next year. Now, next year is obviously a whole nother story, but, these next 2 weeks are like make or break for a lot of things. If the Fed, obviously, I mean, they've kind of signaled they're going to go to 50, but the problem isn't the 50. The problem is the dot plot. And, if you look at December 23 Fed fund futures, they're pricing in, 4.6%. So the markets, whatever the Fed has said over the last, call it 6 to 8 weeks, the market's just not buying it. They're not believing that there's going to be a 5% handle on the overnight rate by the end of next year. And pretty much, if you kind of read between the lines, that's pretty much what many of the Fed governors have indicated. 5 to 5.25% terminal rate, and it's going to be held there. And most people are thinking no rate cuts. So you got 40, 50, 60 basis points maybe of upside on the December 23 contract. The 2-year just goes with the 23 contract, and so the way I'm thinking about it, if the Fed delivers a 5.0 or a 5.1 on the dot plot for 23, it's like lights out. And, you're going to see the 2-year rip. I wouldn't be surprised if the 10-year if the yield curve got more inverted, because the job market's so strong and market's going to start worrying again about over-tightening. And it really, to me, I'm really surprised to see a VIX trading 22, with all this data coming on next week. So, I think it really comes down to that. And, everything else is pretty much like, is going to go wherever that goes. And, my call has basically been, if you look at PPI report today, if you look at services, ISM, and you look at that prices paid index, like Michael Kantrowitz mentioned, that number doesn't suggest inflation's coming down at all. A 70 handle is basically in line with where it's been the last 3 months. And best of my estimates, that number seems to lead the CPI by about 1 month to 2 months maybe. So, you're talking maybe a 7 handle CPI maybe into February based on that. And then when you look at University of Michigan consumer inflation expectations up at 3%, that's a number that probably makes the Fed nervous because it's moving in the wrong direction. It's been moving up. Look at PPI today. I noticed PPI food inflation was up some astronomical number. So all of a sudden, if you take out that negative 4% decline in CPI last month due to the reset in healthcare prices, health insurance premiums, all of a sudden you have a very different inflation picture. And so I wouldn't be surprised if we got a hotter number next week. That's the way they've been trending. That one number in October seemed to be a little bit of a one-off given the reset. You get a hotter CPI number and you get a more hawkish Fed than what the market's expecting. And it's not going to be a fun end to the year.
And Michael, this is all happening into what's a less liquid time of the year, is it not? So I'll tend to exaggerate whatever moves one might see, no?
I would think so. Usually going into month end, you see an increase in reverse repo activity, which is going to be a drain on liquidity to begin with. On top of it, you're going to have a quarter end and a year end. And typically going into year end, you have the largest, activity in the reverse repo market. That's going to drain reserve balances down. I'm thinking they may go below $3 trillion before this is all said and done this year. And that's going to be another massive drain on liquidity. And so I think that these next 2 weeks, these next 3 weeks, I know a lot of people are very bullish. But I also know that the CTAs seem to be done covering. And from what I understand, they're turning sellers again. And, you add that on, plus all this other activity. If you don't get the good news this week, I think the next 2 to 3 weeks are going to be brutal.
Hey, Michael, I don't know anybody who follows the numbers more closely than you, talking about the Fed balance sheet and whatever. Can you just you mentioned the reverse repo? Just updated thoughts on the TGA account.
So the TGA account was. I thought the Treasury said they wanted to get it up to $700 billion by year end, and then yesterday the number comes out and it was down $100 billion, down to $400 billion, and I was stunned because that's just going in the wrong direction. So I'm a little confused with what's happening on the TGA right now. I had thought, given that reverse repo activity started to increase, we would see a decline in reserve balances this past week, but that didn't happen. So liquidity's pretty much been around that 3.1 trillion mark now for the better part of about the last 4 to 6 weeks. And that's why you're kind of stuck in this market, I think. There's no liquidity really coming in. There's no liquidity really coming out.
So with all that, like you said, it hangs in the balance. If we get a hot CPI number. And by the way, sidebar for everyone, you should all follow Michael Kramer, not just on Twitter, but he writes a great market commentary, which was free up until recently. And reach out to him. I think you can get a free trial on Seeking Alpha. It's very moderately priced and it's tremendous value. So I urge everyone to take a trial from Michael, see if you like it. I don't know. Michael, I have to commend you. You do a better job than anybody I know in terms of following the short-term numbers. So do I recall from something you wrote yesterday or the day before, or whatever, isn't the Cleveland Fed has been pretty good on this stuff? Aren't they leaning towards a hot number for the CPI next week?
So, yeah, the Cleveland Fed is looking for a 7.5 number, and I think the estimates are for 7.3. And so Cleveland Fed up until October was like lights out. They would just every single month, like 18 or 6, I want to say 17 or 18 out of like 21 months, Cleveland, since going almost 2 years, Cleveland Fed just lights out. If they said the number was going to come in at 8.2, CPI came in at 8.3. Always. And so October was a curveball because of that repricing of the health insurance, which caused the miss. I'm assuming that Cleveland Fed has now got their house in order. So that's been a very reliable indicator. And the only reason there's any sort of hesitation on my part on this is because of what happened in October. Sorry, my dog is barking.
By the way, Michael, hold on. What type of dog do you have?
I have 2 Goldens.
They're awesome. How old are they?
So the little one is 2 and the big one is 4.
I always say dogs are better than people. Dogs are honest.
Yes.
They're present and they give unconditional love. Even when you get your market call wrong, they still love you, man.
Right, exactly. They don't care.
By the way, Michael, just to clarify one thing, the only reason Cleveland Fed got October wrong was because of that healthcare insurance adjustment. Is that correct?
Right. I mean, there was a 4% month-over-month decline in the health insurance numbers because of the way the Bureau of Labor Statistics calculates it. They do something with measuring retained earnings of health insurance companies, which I don't understand how that works. But basically, if you go and you look, I did an article today actually on Seeking Alpha. I posted it to my account on Twitter. You'll see the drop. It was the largest drop month-over-month in health insurance premiums since the subcomponent's been tracked, going back to 2006. And you strip that out, all of a sudden you're looking at a very different, November, October reading. So
you know what blows me away? I understand exactly what you're saying, but the market did not see that or chose not to see that. I mean, as Stan Weinstein always has said, what's important is not the news, but the reaction to the news. I mean, despite how obvious that it was a mechanical thing that caused the miss, the market still ran with it. And by the way, tell me something maybe some of you read, or what was in the numbers today? It was the PPI. When they had the PPI take, didn't they revise up the PPI from the prior months?
They did. They revised up the last month's numbers. And I think, what was also scary too is they revised up pretty meaningfully last month's labor wage numbers as well.
So Michael, I'm going to ask you the same question I've asked others. I think it was probably for something you wrote this morning because I am a subscriber. What does it lead to? Forget about all the BS about the economy, all that other stuff. What's your take on bond yields here? Because I mentioned earlier, I don't know if you were in the room, but listening to Vincent Deluard making the case for why inflation is going to be higher for longer, and we're lucky if we get down to 5%. Listening to him make that presentation yesterday, I was just shaking my head saying, I don't understand why bond yields are at 340 or 345 or whatever they are. So I think bonds are as short. Rates are going to go up. What do you think?
I think the front end of the curve should definitely be higher than where it is. I think the 2-year should be much closer to 4.7 to 4.8%, maybe even approaching 5%, right? Assuming that the Fed is really true to its word, that it wants a 5 to 5.25% rate, which is what, all the hawks seem to be saying. And, the 10-year, I can understand why it's moving down. It's moving down because break-even inflation expectations are moving down. The 10-year real yield has been absolutely crushed over the last 2 weeks. I mean, just look at the TIP ETF. It's been up pretty dramatically. But the 10-year real yield was on the TIP was trading 170. Now it's 120. And so what you're seeing, what I've noticed is that, you know, break even inflation expectations just basically trade with oil. So that's really all that's a reflection of. I think markets are looking at oil and thinking something's wrong here. Oil's falling, the dollar's falling. That doesn't make sense, right? That shouldn't be happening. Oil should be strengthening with a dollar that's gotten hammered the way it has. And the only thing it leads you to believe is that, you know, there's something going on. Demand is disappearing. I mean, we were supposed to have China coming online. This morning, I thought for sure oil would rip when Putin made that announcement, and it still ended down. I don't know what is going on there, but falling oil, falling dollar, falling yields is a really risk-off sign. And I'm not really sold on the recession yet. I'm kind of thinking we're probably like in some sort of stagflationary period of time. We're just in this high inflation, 1% real growth rate type of environment. And if that's the case, I mean, it's just going to be like constant, you know, back and forth in the market. Oh, inflation's coming down. No, it's going higher again. And the thing that, you know, I've read a lot about inflation for years now, really, because I was always concerned about deflation in, you know, 2015, 2016. And it's very, like, from what I understand, I've never lived through, I was born in 77, so I missed all that fun. But it seems like it's bubbly. It shows up in like goods, and then it rotates into services, and then it rotates into wages, and then it goes back into goods. And you can't look at one group and say, oh, well, good prices are coming down now. That's solved. Actually, no, it's not. The dollar is weakened. Look at the dollar versus yuan over the last couple of days, and it's absolutely collapsed, right? The yuan strengthened dramatically. Guess what's going to happen to import prices? Import prices from all the stuff we bring in from China going to start going up in price again because the dollar is losing value. All of a sudden, the benefits of the strong dollar are beginning to fade. And we are going to start seeing probably goods inflation again. In fact, if you look at the China credit impulse that Bloomberg has, it is starting to rise again. And typically the ISM manufacturing gauge kind of lags that, I think, by about a year or so. And so I don't think that this inflation problem is solved at all. I just think it's moving around.
That's excellent, Michael. Michael, I'm going to be unfair and ask you a pointed question. I don't know what a sports guy you are if you do any betting in Vegas, but
I'm a Bills fan, so I've been tortured my whole life.
All right, okay. So Michael, just to sort of give context to your bearishness, one touch option. Where do you think the low print for the market will be in the first quarter of 2023 on the SPY and the S&P index?
That's a tough question.
Or let me put it another way. Do you think the market will be down 10% at some point in the first quarter?
Yeah, I think we could see 3,300
in the first quarter.
Yeah.
And if you're wrong, how much upside do you think this market could have?
All-time highs.
I know.
I mean, there's $2 trillion slushing around every day in repos. So I mean, 4,900. Who knows? It's crazy.
I love your answer. Man.
I mean, all you got to do is get the CTAs to go like 100% long or something, and this market could be up another 20%.
Yeah. So let me get this right, Michael. The bull case is things are so bad we're going to have a recession if the Fed's going to ease. Did I get that right, Michael?
Yeah.
You're the best. Anyway, everyone follow Michael. He's on Twitter. Reach out to get a free trial for his Seeking Alpha. I have no commercial relationship with Michael, so I don't benefit from this. I'm just telling you, I take his service. Well worth the read, and it's really a modest amount of money. Storm, a quick follow-up from you before we go to Neely. You got a quickie, Storm? Because I want to get on to Neely.
Yes, real quick, because Neely is going to be fantastic for Michael Kramer. You said peak dollar, peak oil. What's your thoughts in the correlation with gold? And then the top 15 largest organizations holding $1 trillion in cash.
Wait, Storm, hold on. I don't understand the second part of the question, and we're not going to allow that one. That's kind of off the reservation. So let's just keep it simple. Michael, what do you think of gold?
So it was funny. The other day, you asked that because the other day I just wrote a story in my subscription service talking about how I was seeing a lot of upside call buying And I only do it when open interest levels change. I think they were looking for 180 on the GLD, which equates to about 1,800 on gold, and they were selling the 190 calls. And so it looks to me, from looking at that and then looking at the chart, I thought gold had upside, and it makes sense if we're in sort of a defensive risk-off environment.
Fair enough. All right, Neely, I'm so glad you're here. We need to hear from you. There's a lot going on in consumer land. A lot of things are blowing up. Most notably, we had Lululemon today with an 85% inventory increase. So, Neely, what the heck is going on in consumer land? I yield the floor to Neely. Please unmute yourself. Go for it.
Thank you, George. Actually, can I ask a follow-up question to Michael? Because this might
go
tie
for it.
into...
Go for
Michael, is your expectation of TGA to be higher than it is because of how you model those numbers off of last year? And it's a leading question because December was such an outsized cash deposits month because of payroll taxes on a catch-up that I'm wondering if that's part of functionally why, relative to maybe a model, TGA is coming in lower. It's like down 7% month to date, year over year, but we are modeling it to be as much as down double digits by the time you're done with this month because of that dynamic.
So you're asking me?
I am asking you.
So I am basing that number off of a press release that the Treasury put out on October 31st. They were in that press release forecasting $700 billion in the TGA based on what their issuances were going to be. Also, I'm referencing that number off of a couple of sell-side reports. I think I read one in Bank of America where they were sort of putting that in as their end-of-year number as well. And that's why I'm looking for that number.
Interesting.
I know after this year, though, I know the TGA is supposed to wind down.
Mm-hmm. Yeah. If we want to connect separately, feel free. I can help you out a little bit with what I know, if it's helpful. Yeah.
Sure. Thank you. I will.
Yep.
Thank you.
So, consumer, we're right now, let's see, let's go, George. I know you like a good agenda outline. Let's talk holiday near term. Let's talk about expectations for commentary in January, February. And then let's talk about some consumer capacity timeline factors. Does that sound like a good outline for you? You like that? He's like making dinner. You like that?
Neely, I'm sorry. I had you on.
That's okay.
Go for
I'm
it.
giving you an agenda because I know you like a good agenda. Okay.
All right. I'll pay attention. I promise.
Little holiday near term. Retailers' expectations, conversations, at least based on, conjecture on our part, January, February, and then maybe some consumer capacity timeline issues in early 23. Does that feel good? I'll do it. All right, here we go. Tuck in, everyone. Holiday. We've got 5 Saturdays this year versus 4 last year. While that sounds enticing for capacity, what ends up happening is that consumers or retailers panic right about now because they're comparing their sales trends versus last year. And it's that panic at the disco that causes them to look at those increase in inventory levels and go, oh, we need to start marking some of this stuff down because inventory values on December 26 feel very differently than inventory values on December 25, right, to a retailer. So I have been following Kantrow's work for a while. I love the focus on the P in Hope. We think he's got his own, framework and what have you, but we think the story for retail for holiday is going to be holiday sales could end up being like ho-hum, and it won't be all come all you faithful when it comes to profits. I think it's going to be a little bit shakier by the time we adjust out all of the accrual accounting for markdowns, et cetera. What that can mean for how retailers message, because again, they're on a month delay versus the rest of the market, right? They're January year end typically, or summer, February. You'll probably hear what you'll hear from normal, S&P 500, and the retailers will be like, Yeah, it wasn't that great. I mean, if you recall, you had some tale of two cities in terms of different retailers signaling different trend changes, even in February and March last year. We don't think that those comparisons necessarily ease for them as it relates to unit sales. And if anything, they're coming in on fumes on price. So it's the conversion rate in the units that are probably author some caution as they give their outlooks for 2023 would be our conjecture. All right. Now, here's what's interesting. The consumer might have some fascinating, like very, how do I want to say this? Like whiplashy sort of consumer capacity situations in Q1. So do with this what you will. In February, we're going to have the Supreme Court of the United States actually listen to arguments for whether or not Biden's student loan forgiveness plan is constitutionally valid. It is generally believed that the Supreme Court will end up saying, yeah, it's not constitutionally valid, given the structure of the Supreme Court, given the shakiness of commentary, even out of, Nancy Pelosi talking about it's not constitutional in nature and what have you. The case doesn't look great. We'll just put it that way. Not a legal expert, just that's kind of where me listening to legal experts and reading their work have indicated. If that's the case, you have 60 days as soon as that argument comes down for payments to go back into repayment because the executive order will be nullified. And all of a sudden, everyone has to start paying back on $1.7 trillion in student loans. That, my friends, is going to be a very negative consumer capacity issue for the economy. A lot of people are very likely to default on these student loans. In contrast, however, our firm, which does very deep work on consumer capacity, has alluded in one of George's earlier spaces, though we have not published specifically this work, we've published the direction of this work in Twitter, that we believe that it's going to be a very robust tax refund season for many, if not most. If that's the case, you could have a situation where it's like a bad news in February. If the judgment comes down in February, that's still TBD. And then a good news when you have your tax season in March. But all in all, we're concerned about what that might mean for pushing inflation on the good side even further because people spend their cash. I'm going to pause there. It's going to be a crazy Q1. Y'all got to stay in these spaces and pay attention and follow the bouncing ball as it goes along because I've been doing this for 26 years. I've been studying the consumer more than half my life. And this is the wildest start to a year I think I'm ever going to have the opportunity and honor to analyze. So I'll just pause there.
Neely, that's absolutely brilliant. There will be volatility. Prices will change. I get it. Question. Let's go to the here and the right now. So Lululemon, 85% increase in inventories. I mean, there ain't enough lipstick in the world to put on that pig. Like seriously, like with a straight face, they're talking about investing for the future and building for future sales, but 85% increase in inventory, doesn't that just speak to how hard it is even for the best of managements to navigate this environment?
The market voted on that number today, did it not?
So, the market vote was basically saying they didn't believe a word management was saying.
Yeah, the market voted on that. I'll never forget, this goes way back to the 90s, but I'll never forget when there were retailers like, the teen retailers were super popular, right? In the 90s, the specialty retail, teen retailers, they're all going public, what have you. I mean, there were some teen retailers that were doing literally like 80% increases in same store sales, okay, month after month after month. And the inventories were crazy. But, at some point, and I've seen it over and over again, the music stops, right? The record scratches and there's a few chairs short of the circle. And it has not happened to a retailer so far in 26 years of professional observation. I don't know if this is the music skipping on the record for Lululemon or if it is truly a record scratch moment. I don't have enough information or expertise to weigh in on that. But I know that I have not yet seen a retailer survive a condition in which they continue to outpace expectations on their sales and also increasing on their inventories. it comes home to roost.
Yeah, but Neely, we're talking now about Lululemon, okay? We're not talking about Target, where, blowing numbers is part of the business plan. This is freaking Lululemon. If Lululemon can't get it right, what does that say?
Hey, consumerism's all about meeting a need or a desire. And there is always a test, right, as to how much you can hit from a total addressable market. Not everybody's a Lulu customer. Not everybody's a Restoration Hardware customer. Not everybody's an Ulta customer. There's no perfect formula to figuring out where is that limit, where is that test on your true total addressable market. It has never matched, however, anybody's 10K or IPO roadshow. Wow. So both up or down, by the way. So, at some point it tests, and, as you would know, as you and I both each learned from the great Peter Lynch, inventory matters.
So, Neil, let me ask you another question. You'd pointed out a few weeks back in one of the spaces how retail, if I think I got this right, how retail sales had started to pick up a bit. It coincided exactly with about the time the oil prices went down. If I'm not mistaken, oil prices have continued to go down. So in terms of the pace of retail sales and how the consumer is doing, you're more in the weeds in this than I am, but generally speaking, the news out of the economy has been better than expected. What can you tell us about what's going on with the consumer?
Inflation-adjusted retail sales have not been as robust as reported retail sales because they don't adjust their numbers for inflation. So no, I don't know. I don't know exactly where it's going to be. What I do have a sense though of, George, is it doesn't matter what November's number was or is. What matters is how they're feeling in this month. And, it's entirely plausible that with these too high inventory levels and this mismatch on the weeks, this lull's going to hurt. And it's going to cause them to pull some triggers on promotions and profits.
Let me ask a slightly different question, Neely. This concerns wage costs. Because, wage increases are really at ground zero in terms of concerns about inflation expectations. And inflation, is a process, it's not an event. And I recall reading a couple weeks ago, I think we were in a space together where I read this out. Blackstone had reported that whereas they fired a lot of people early in the pandemic, we're talking about folks at the lower end of the socioeconomic strata. I think they said the average person was making $12.50 an hour. They found themselves having to rehire these folks at $19 an hour. And I forget the exact percentage increase for this year. I can't remember if it was 6%, 8%, but they're also looking again to the year ahead for 2023 at significant wage increases, 6, 7, 8%. Do you have any sense in general terms, in terms of what retail companies are looking at with respect to increasing wages this year and next year?
I don't, to give you a general number. However, perhaps this answers your question. We're getting a lot of, in our consulting work, we talk about the labor force quite a bit. And there's a lot of conversation around task automation. So I think it's entirely plausible that there are plans that are not put forth kind of in the general domain because it's unpopular to put out a press release saying we're going to redeploy some of our capital away from humans and towards automations. But it's not, I think a lot of people think like, oh, it's just about robots. I'm like, no, it's things like, do we actually need to have all the meetings that we have? Do we need to have all the reports that we have to have? Are there other ways to do reporting? Are there other ways to do these tasks? Are there fewer people that we need in support functions and more people towards productivity functions? I mean, I think it's that sort of heavy work that's going on. And I think that makes me really bullish. I will never short America, right? I think that is what capitalism is and what it does. But it's an unpopular press release to put out when you're saying you're looking at task automations.
Fair enough. By the way, Neely, I can't say how much I really appreciate you coming in these rooms and sharing your wisdom with all of us. It really, it's so helpful to me, and I'm sure I speak for others in the room. By the way, just for everyone, I advise us it's Friday, here on the East Coast at 724. Neely, where you are at 624. I'm drinking Chardonnay tonight, which is really making me enjoy these spaces even more. When I drink red, I'm good with Chianti or Pinot Noir or Cabernet, but really liking this Chardonnay. I usually do a Chablis, but Neely, I love your comments. Thank you so much. Please stay on stage. I'm sure we're going to have a lot of follow-up questions. Let's go to Gnostic and then Ben. Gnostic, good to see you. What's up, my friend? Please unmute yourself.
Hey there, George, my man. Oh, I just lost my earpiece there. So, what I was going to ask Neely, I suspect that the fall in purchases for somebody like Lululemon has something to do with an overpurchase during COVID, when everybody went out and bought things for their own use and weren't buying work clothes or anything else. Do you think that the COVID overpurchase had anything to do with their overestimates of both inventory and consumer purchases?
Oh, I think that's totally plausible. I mean, even some of the early holiday sales, right? We saw that the usage of buy now, pay later, which of course is, kind of the layaway or subprime function of consumption, right? For, a group of probably lower income consumers and what have you. But people who truly want to consume and aspire up. And we saw that during the Black Friday, Cyber Monday week that, usage expanded on buy now, pay later, yet the average value went down, while pricing. And some people pointed that they're like, see, we've solved inflation. And I'm like, no, it means that they're needing to use buy now, pay later, right? For what would normally be like a pack of gum. It's like when you go to Target and they're like, hey, do you want to open a red card? You're like, I just purchased a $1 pack of gum. Are you kidding me? No, So I think it's probably more indicative of that, is more of the overstretch on the capacity on credit. It's a hotly debated point, but I think that there's enough points out there that say it's not looking great. And I think what concerns us is rolling ahead to next year, and very soon, right? Very soon, if we do hear, and it's not clear to me, if anybody here actually has true legal expertise, especially on the Supreme Court, and you want to give me a definitive answer, because I've seen a whole range of answers on this. If that judgment comes down in February, payment processors will be out the next day with notifications. Okay. Like, they're not going to wait for 60 days to do their notifications. They're going to do it like the next day. These people have not been paid, right? This entire time since March of 2020. And, those payments can start being collected 60 days after that judgment. The latest that would happen would be in the summer, which goes to, I think, Kantrowitz was talking about, he's really concerned about the P in hope, right? The profits piece in the second quarter. It could come as early as the first quarter on that SCOTUS decision. So I'm just concerned about that nature. We didn't even talk about the small business piece. Gnostic, I care deeply about small business, but that's the other thing that we're watching for. Small businesses are suffering big time right now, and they are consumers. And so we think that they are also stretched. Could it be that you had some small business owners that were buying Lulus that now no longer can? It's a bit of a stretch to make that comment, but the answer is yes. A retailer doesn't fall apart because of, of their core customer abandoning them. A retailer starts to fall apart because their fringe customers can no longer afford them, or they lose relevance on that fringe customer. It's not the core, it's the outer ring. And that's probably what's going on.
Say, Neely, I had a question. Concerns real estate. So one of the listeners put a question and wants me to ask, have you done a deep dive on the fact, looking at real estate appraisals, that real estate values have gone up so much for so many consumers the last couple of years? What effect will that have, if anything, on consumption? And then secondly, and perhaps in the opposite way, in a negative way, there was a tweet making the rounds earlier this week talking about the emergence of negative equity. It's something we haven't had to deal with in years. And the tweet, I don't have it from memory, and I've had too much Chardonnay. I seem to recall it said something like there was negative equity, I think, in 8% of mortgages taken out in 2022. And it was like 30% of all the mortgages taken out in 2022 in Colorado Springs had negative equity already. So just weighing in generally on changes in real estate prices, A, what effect does rising, increasing appraisals have, and then B, the fact that negative equity is going to be coming soon to a theater near you, and just thoughts on that generally.
Can't speak to the negative equity piece. Have not personally done that work, but I do think in general. As a general statement, I think most people, I've heard that same statistic around 65, 85%, whatever the homes that have been purchased are like at a mortgage rate under 5%. Like most people who are in their homes are going to try to make their homes work. They may not move, they may not sell unless they have to, right? But they're generally speaking going to try to make their homes work because of where they are on their rates and because of where they are, on that payment. That's the current homeowner. I believe that, and that's probably true. And there's probably some, spread on the HELOCs and what have you to be able to weather through some of that. What concerns me, though, is that all of that super high pricing on homes already went through every property tax assessor's office. And I don't know about you, George, but my property taxes, I don't have a mortgage, but my property taxes are up 17%. And I'm like, okay, I tried to fight it, didn't work, so that's the thing that I think will catch the homeowners up is when they see their property tax bills. And every single county does this differently. So I don't even want to try to it's not even worth the analysis to do that, but it's higher. It's like Monty Hall, right? It's higher. It's not lower.
Yeah, no, that's definitely going to be a feature. One thing I have to tell you though, admittedly, Westchester County here outside New York City is not representative. I happen to live, my partner is a major real estate player in Scarsdale, New York, which is one of the most affluent addresses in the country. I think it's the most affluent address in the state of New York. And, obviously cost of money is not so important here because so many people pay cash. By the way, sidebar for 1 second. Neely, I read something the other day. I was stunned that the number was this high. Does this sound right to you? I read something the other day which said that 42% of all homes do not have a mortgage. Does that sound right to you?
It does, because I think it's the boomers, and the older boomers particularly. They've paid off their homes, and I'll tell you why that makes sense to me, because we actually not only look at the data that comes out of the Census Bureau, which actually produces that statistic, but we have we're nerdy. I'm just going to preface this by saying we're nerdy. We actually go through the IRS data. There's ways you can actually surf through IRS data to figure out whether or not people have filed, their itemized deductions, right, on mortgage interest payment, et cetera, especially pre the Tax Cuts and Jobs Act. And I remember seeing the data on doing that through the IRS data. And we do this state by state. I don't really advertise this that often. I know we're on a recorded line. I'm fine saying this because people can I'm just going to put this preface. I'm not interested in selling you this data. It's for us and we use it proprietarily. But we actually have about 20 economic metrics that we use that we created out of the IRS data by zip code. So we're nerdy. We're really nerdy. And I remember looking at the home ownership rate through the lens of the IRS, not just how it's reported in the Census Bureau. And I was like, that's really low. It's actually the home ownership. Let me say it this way. The home ownership rate is even higher when you look at it in the IRS eyes versus the Census Bureau, which gives me pause that the Census Bureau is actually not fully calculating the things that you and I just talked about, boomers actually owning their homes.
By the way, it's really interesting. When I so rudely interrupted myself, I do that a lot. The funny thing in here is, even though prices have gone up so much and cost of money has gone up so much, I'm told that the biggest factor constraining sales right now here in Westchester, believe it or not, is lack of inventory. There's still nothing for sale. I mean, okay, you go to Phoenix and, Orlando, whatever, you got all these massive subdivisions and where a much higher proportion of the sales are dependent upon mortgage financing. It's a different picture. But in places like Scarsdale, New York, the only thing holding back sales is lack of inventory. If anything decent comes in the market, there's a zillion buyers. Does that surprise you?
No, actually, it kind of doesn't. We have some hands up. Gnostic, did that answer? I know we took a total tangent, like down to Pismo Beach, but like, did that answer your question?
Yeah, that was a pretty good answer. I mean, I live in Vancouver, so Lululemon, the owner of Lululemon doesn't live very far away from me. Our ex-owner of Lululemon doesn't live very far away from me, so I always get jokes to him through a friend of mine who their kids play together, so it works out to be kind of funny sometimes. So I'll poke him on this one and see what he has to see if he has any information, but he doesn't have access like he used to. So in housing, George, one of the issues is when everybody expects the recession to be short and interest rates are going up and it starts impacting things, people just stop listing their homes. So all of a sudden you get a breadth of inventory, which stabilizes prices, but it's actually an artificial process. If they turn around and have to suddenly sell, you get a steep decline in pricing fairly quickly. So it doesn't surprise me that people in Westchester wouldn't be listing their houses for sale because it's a good asset. Why sit on it? And there's no place to roll your money over at the moment on 31-101. So why sell right now? There's no reason for them to sell or list. So
makes sense, Gnostic. Okay, so we're going on 1 hour and 45 minutes. We have 3 speakers who haven't spoken yet. If anyone else has a question, raise your hand. Otherwise, we're going to do Ben, Howard, and Average Joe, and then we're going to close the room. Ben, please unmute yourself. The floor is yours.
Been a long time, George. How you been, my man?
Hey, man, good to hear from you. What's going on?
Yeah, not much. Yeah, Neely, good to see you. Michael, by the way, love your work on Seeking Alpha. Yeah, no, just popping in a little late in the room, so my apologies, George. But, just thought I'd comment briefly on the price action for the week and just the close of today. Jared, I think we haven't talked in a little while, George, but I think we're generally aligned in terms of just the market trajectory. It was a little shocked last week with regard to the Brookings Institute rally off the Powell commentary. Not a lot of news there, obviously, right? It was really just the notion that there was some sensitivity to over tightening. And, he made the comments that basically solidified the 50 basis points for next week, which, was largely already priced in. But, of course, that rally's been peeled back. Thinking we might close that gap down to the CPI from last month as well. But, market's starting to behave a little more rationally. So I thought today's price action, when you think back actually last week with the non-farms, kind of similar, right, where it caught a bid, strangely, during the cash open, and saw something similar today with, the hot PPI, and, market caught a little bit of a bid before puking it back here at the end of the day. But, yeah, no, I think things should get a little more constructive, George, and we all like to talk market calls in the S&P, and I'm just still kind of at that 3,200 level, man. I think a 15% haircut on earnings, take it from 230 down to 200, slap a 16 multiple on it. Let's just call that an average multiple historically versus where we're trading now, about 19, and get you 32, man. So I think you get 32 in the first quarter. You probably get constructive there. But it's just kind of wild to me, man. You keep seeing these bulls keep pouring in, man, and it's these weird Fridays with the 0 date to expiration options activity that's going on, and it's all this. There's still that speculative dollar in there, George, that we had talked about year plus ago, back in the clubhouse days, and until that gets washed out, it's just really, really hard to get constructive in this market. So just my thoughts on trajectory. That's
Ben, really good to hear from you. It's been a long time, but it's kind of like two lost lovers. We're in the same place. We think the same way. And I'm just reminded of what Michael Kramer, where did he go? He was on stage and he disappeared. Kramer was talking about how long is it going to take? How much longer is the market going to disobey the Fed? It's like the market will heal to the Fed here at some point, but they're not going quietly. That's for darn sure. So great to hear from you, Ben, and please come back to these rooms. Let's try to move on here. We got Howard and then Average Joe. Howard, good to see you. Please unmute yourself. The floor is yours.
Thank you so much, George. And I'll keep it quick. 2-part follow-up question for Neely from your 42% of homes with no mortgages. I remember that until about a year or two ago, that number was looking and had consistently looked like 50, 51, 52% in the U.S. No. And I'm wondering if we've really seen that much of a decline or if we're just looking at disparate statistics. And secondly, if Neely, if you know the total estimated home values that aggregated that are the percentage that's currently mortgaged, because I'm wondering if we just stumbled on a real shrinkage in home ownership in America, in outright home ownership.
Howard, I know I can just weigh in there. I would have to double check. I don't know if that number is fully knowable. It might be guessable. I don't, in like a good guessable. I don't know if it's knowable. But, you and I have a good dialogue on the back channel. So I'm going to follow up with you when my brain is in nerd mode in the mornings. Okay? Yeah,
Sounds like a plan. Thanks for that, Howard. Appreciate it. Average Joe, please unmute yourself.
Hi, thanks for taking my. I have a huge question. It's like a perfect storm back in '08. I'm just wondering when the big three is gonna. If you haven't been following the auto sector, I mean, our bread and butter is now the top three in inventory. We talked the Ford F-150, the GM's truck, and then the Ram 1500. Housing is falling, and the difference is that financing for the housing is the big financial companies aren't in trouble, but at that time in '08, the GM had finance, Chrysler had their own finance, and they started getting in trouble with repos and people defaulting. And, people aren't paying attention to that. We know that there's been inventory fluctuations as far as because of coronavirus, but the bread and butter is there. Those three vehicles drive American companies.
Right. So Average Joe, let me ask you. So what is the question for Neely, please, Average Joe?
Don't Neely. I mean, if that factors into next year's first quarter, is it going to finally allow us to understand that we are truly going into a deep recession? Is it, what is it going to take for people to understand that we are, and the dollar will prop up because we need it to prop up in value to keep this country going? I mean, so do you think that's going to be the final, the final stake in the heart of America to finally say that, hey, yeah, we are in a recession?
I don't have a great answer to that, George. Joe, I just want to affirm, you are asking a good question. I'm very singular in my skill set, and that is not one of my skills. So I just need to yield the floor to someone else if that was coming to me.
Yeah, no, I think, well, Neil, let me ask you a more general question, which is related to what Average Joe was asking. Let me ask you a more general question. And that is, when you look at, and I was seeing the data in an article there, I'm sure you know it by heart, but you're looking at I was blown away, the amount of the average auto loan nowadays, and the average term, the average payment, people paying some insane numbers. I mean, do you have any thoughts on what's happened to the size of the average payment in auto loans and how sustainable that is?
It's knowable. I just don't have it at my fingertips. I haven't memorized that. Yeah, but it's knowable. But here. Let me answer back a framework back. This is actually really helpful. One of the things that has concerned me this entire year is people have been pointing to auto delinquencies super all-time low. I'm like, yeah, because you can turn that car right around and sell it for more. Okay. Relative to where you bought it. That's pretty much been the dynamic all this year. And so I think auto loans do typically lead on some delinquency behaviors out of the consumer. But what has concerned me is that the value of the used car prices, and kind of returning those back has actually hidden some consumer strain. So it's a great question, but I would just say like it could. Well, I'll answer it this way too. We're in the market. Our family's in the market to buy like a used truck. I'm waiting. I'm waiting.
Yeah, no, I mean, wasn't there a number out just yesterday, the day before, like the Manheim November number was like down 14% month on month or some crazy number like that. It was like a record 1 month decline or something.
I think that sounds right.
Yeah, so I mean, I remember you and I were in Clubhouse 2Q21, and people were trying to wave off the inflation numbers. Like, it's just used car prices. It's just used car prices. Well, we know it wasn't, and now that's running in reverse. So I don't know if Nicoski's a motorhead, but he wants to get back up here. Dave, you want to say something about this? Dave, unmute yourself.
Yeah. Hey, and I, as a technician, I don't look at all of the data. Is there any precedence of, looking back at the 08, 09, repossessions for vehicles as well as rentals? If you look around the market here, supplies of homes are surging and getting huge price reductions. Is there any precedence for, homeowners that can't sell their home or second home, that they go into the rental market, or that, something like a Carvana explodes and you see a mass amount of autos come into the market that drive prices lower? I would imagine the auction markets are going to be a hot place shortly, and that we could see home rental prices come down, or renters equivalent, in terms of those that can't sell would choose to rent and may have to subsidize the rent to make the mortgage payment.
Well, Dave, I'm not sure I followed your question because I've had 4 glasses of Chardonnay now, but let me say something which is relevant to that. And that is, I was reading something yesterday and was talking about how, and Neely, this is a statement, it's a question for you, how the auto market is going to go from one extreme to the other, whereas the reason that used car prices have gone up so much has been a dearth of new car supply. And rolling forward, new car supply is going to go through the roof. So that's going to depress the price of used cars. Does that make sense to you?
I think it kind of does, but I need to think through that just a little bit.
Yeah.
I'm a thinker.
Yeah.
I'm a thinker.
Yeah. So no, I get it. So Dave, as opposed to the housing market where we had the great Ivy Zellman, and by the way, we got a problem here. Got to call security. Maybe Howard, you can call security for me. We got 2 smart people from Minnesota up here, and so I don't know if this is a plot or something like that, but these Minneapolis people, got to watch out for them. They do this aw shucks wholesome Midwestern shtick, but they're pretty sharp. So be careful.
Hey, if you think you hate us now, wait till you get to know us.
Howard, what do you say, Howard?
I called the authorities, George.
Call the authorities. Security.
Hey, you know what, George? I was born in Florida, but I can, talk about going down the road and doing a meat raffle if you want.
Let me ask you a question. I get why people leave Minnesota to go to Florida, but you're wrong way, Louie. How did you wind up being born in Florida and now you're in Minnesota?
Oh my gosh, it's Piper. Piper brought me up here originally.
Oh, Piper.
And then, that's who recruited me. And then, I'm here. But you know what? As much as this place just drives me bonkers, it's I love it. I'm staying. It's home.
Okay, so Neely or Nicoski, either one of you can have a go at this. Why are the Minnesota Timberwolves always so bad every year? Does anyone follow basketball?
Go sports ball. Does that answer your question?
It's kind of
I'm a baseball girl.
It's like following the Vikings. It only leads to disappointment. And much like the Seinfeld episode, where everyone gets together and tells each other how each other has disappointed you in the last year, that's pretty much Minnesota sports for you.
We got to get Larry Jetalo in here, another Minneapolis guy. We should do an all. You know what I'm going to do? Neely, I need you to quarterback this. You have to be the ringleader. I want to do an all Minnesota investment panel. This will be something different. So I don't know who else is in the Minnesota investment mafia, but Neely and Nicoski, you 2 guys can figure it out. We should do just a Minnesota room. Or it could be worse. We could do Wisconsin when we get Jeff Garbaz in here. Whatever.
Well, we could get I mean, I don't know what you think, but we get Nigeria in here too.
Oh, please. That's my red line. Sorry. All right. All right, we're going to do Jeffrey, and then we're going to close it. Jeffrey, please unmute yourself. Good to see you. What's up, Jeffrey? Please unmute yourself.
Hey, George. I just had a quick question really for you or anybody else. I understand your thoughts on the bonds, but as I look at every commodity out there practically, they all look terrible. I mean, the charts are horrendous, not just bad, but many down 50, 60%. Over the last year, we've actually had gas go below last year at this time. And I share your thoughts completely on the equities. But it seems to me that, particularly now I'm into my third glass of rosé here in San Diego. I'm looking at the sunset, so the world seems...
Hey, Jeffrey. I thought you were a good guy, but you're drinking rosé? Like, seriously?
I know. It's sad. But, I'm in California, George. What can I do? You just can't have a...
You guys in California are off, man. Keep going.
It's true. You're not wrong.
Yeah,
Minnesota, come on. I mean, my goodness sakes.
By the way, just for the record, it may be 7:50 p.m. East Coast time. Everyone in this room, please note, it's only 4:50 p.m., and he's already in his third glass of rosé. So that then begs the question, what time did he start? All right, go ahead, Jeffrey.
Well, the market closes at 1 p.m., George. It's Friday, for God's sakes. What do you think? 2 o'clock? Come on.
All right,
anyway, the commodity charts too. They look bloody awful. Are they lying? Am I missing something? Is that disconnected from the bonds?
Hey, I'll take this, George. I posted several weeks ago, like the BDRY, which is the dry bulking index, and it's tethered not to the stocks, the equities. It's tethered to pricing for dry bulk carriers. You're seeing bottoms in iron ore. If you look at the iron ore, China iron ore prices, I mean, absolutely vertical. You're seeing it in nickel. You're seeing it in aluminum. You're seeing it in zinc. Okay, China is opening. And, I've addressed this on many calls over the last month. China has been locked down for 2 years. They completely shut down. We should expect COVID cases to surge. That's your tell, unless the laws of physics in terms of viruses do not exist in China. They do. And that's why you're seeing the outbreak. So China is opening, in my opinion. You're seeing it in commodities, or at least the metals. They are moving up. They have been moving up. And pull up a chart of BDRY. You're going to see that. It was a failed descending triangle. I highlighted it a couple weeks ago.
The metals aren't moving up.
What's that?
Aluminum still looks terrible.
No, aluminum pricing chart actually is bottoming.
Off the lows, perhaps, but they don't look good.
No, other metals.
Let's revisit this in 30 days. I think you're wrong. I agree with you on China. Maybe they're reopening. Yeah, maybe they're not.
Nickel was up 8.18% today.
Nickel is a market that trades by appointment, like every third Thursday.
Yeah,
Jeffrey.
I'm saying you're seeing bottoms in them.
Yeah, Jeffrey, I think your advice is the best advice, Jeffrey. Let's check in 30 days. I mean, if you're not confused, it's because you're not paying attention. It's just like there's so many disparate trends here at work. One would have thought that with all the talk of China reopening and blah, 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 the oil price would be going from, up and to the right. Ain't happening. So something weird's going on here. I did read separately, Jeffrey, I'm sure you follow this, but speculators have been leaving the building at like a record pace. You've had, I forget the numbers, but I forget the number of contracts, but I read something where they said, I think the last 2 weeks has been the equivalent of 190 million barrels of, paper oil leaving the market. So as to remind you, just take crude, the biggest and most important of the commodities. The paper market for oil is 50 times the size of the physical market. So depending on what kind of mood the speculators are in, it could be student body left, student body right. But I agree with you, Jeffrey. It's very complicated.
And I think you're right. It's interesting how the demand for oil futures or the demand for any of these commodities is very different from the demand for the futures contracts for the commodities. And that's where I have trouble. If anybody has any suggestions on how to figure that out, boy, I'd really appreciate that.
Jeffrey, you know what that is? You know what that tells me? You have to be in the room. In fact, I'm going to make you co-host it with me. We need to do a room on commodities. That's a really good subject you brought up. And I haven't heard anybody with a really good answer to that. Maybe I can get Jeff Curry from Goldman or one of these other commodity mavens to come into the room. That'd be a great room. So, Jeffrey, thank you for that. I just want to warn you, when we do that room, you're going to co-host with me. All right.
Hey, George, I just want to tell you, too, though, I do appreciate these rooms. I run a $400 million RIA. I've learned so much from David, Neely, all the people that speak. You saved my clients an incredible amount of money this last year.
Well, I thank you for that. I'm flattered, humble. That's why we do it. All right. So listen, 2 hours and 15 minutes. I'm going to make one more pitch for World Central Kitchen. I think I put the tweet up in the nest. Yes, I did. Everyone, please give generously. This has been a phenomenal room with all the speakers we've had. Where else do you get? Whether it's Neely, Nicoski, Michael Kramer, Michael Kantrowitz. Just, Tom Thornton. We've had so many great speakers in here. Please give generously. None of us do this for any personal benefit. We're here to learn. We've got a great community. It's really something special. I'm flattered, absolutely flattered, that in 15 minutes notice, we convened this room and we had 600 people in the room at its peak. It's been a phenomenal room. I thank you, Neely. I thank you, Dave. I thank everyone in this room for doing this. We'll do it again before too long. I know on Monday we have a space set up for Monday afternoon. Everyone wants a bull, so Barry Ritholtz will be the guest speaker on Monday, and we'll take it from there. In any event, everyone have a great weekend, and stay out of trouble. See you guys next week. Take care. Good night, everyone.
Thank you, George. Appreciate it.
Take care. Good night.
All right. Bye-bye.
Good night.